When you open a trading terminal, what do you see? You likely see a candlestick chart. You see green and red bars moving up and down. You see a line that tells you the current price of Apple or Bitcoin. I am here to tell you that this interface is a lie. Or, to be more precise, it is a history lesson masquerading as the present. To understand quantitative finance, you must fundamentally disconnect your brain from the concept of a price chart and reconnect it to the reality of the limit order book. The number you see displayed as the current price is not the price you can trade at. It is simply the price where the last transaction occurred. It is a ghost. It tells you where the market was a millisecond ago, but it tells you absolutely nothing about where the market is right now. The reality of the market is not a line, it is a queue. Imagine a canyon. On one side, you have buyers shouting how much they are willing to pay. This is the bid. On the other side, you have sellers shouting how much they want. This is the ask. The price is simply the empty space between them. Nothing happens until someone crosses that canyon and agrees to the other side's terms. This brings us to the hierarchy of data. Retail traders look at level 1 data. This is the top of the book, the best bid and the best ask. It is like looking at a store window. You see the price tag, but you don't know if there is one item in stock or 10,000. Institutional algorithms operate on level 2 and level 3 data. Level 2 shows you the depth. It shows you the queue of buyers and sellers sitting behind the best price. This reveals the mass of the market. If you see a thin wall of sell orders and a massive wall of buy orders, you know that it will take very little effort for the price to move up and a massive amount of effort for it to move down. A chart cannot show you this resistance because a chart only shows what has already happened. The order book shows you the intent of what might happen. Level 3 data is the atomic truth. It breaks that queue down into individual orders. It allows you to see if a wall of 500 orders is actually 500 different people or just one large institution trying to spoof the market. This distinction explains why technical analysis often fails. Technical analysis is the study of the past. It draws lines on a chart based on historical movements, support, resistance, moving averages. But remember, the chart is just the exhaust pipe of the engine. The order book is the engine itself. A technical analyst might say, there is a support level at $100. They draw a line. But a quant looks at the order book and sees that there is zero liquidity at $100. There are no buy orders waiting there. If a large seller comes in, that support line will vanish instantly because it was never real. It was just a memory of a previous price. Price does not bounce off lines. Price bounces off liquidity. If you want to build a system that works, you cannot train your AI model on open, high, low, and close data alone. That is low-resolution information. You need to feed it the state of the order book. You need to teach it to calculate order book imbalance. You need to measure the microstructure noise. When you shift your perspective from where is the price going to where is the liquidity sitting, the market stops looking like a random casino and starts looking like a mechanism. In the next video, we will discuss the institutional straitjacket. We will look at why the whales who provide this liquidity are not free to do whatever they want, and how their regulatory handcuffs create the alpha we are hunting for.